financial markets in turmoil.
What are the root causes of the financial crisis?
The dollar losing value.
Heading for its biggest loss in nearly 3 decades.
Will Social Security even be there?
I don't know.
Buy or rent?
That's a very good question.
Interest rates.
I'm not so sure.
Where do you put your money?
I don't know.
Welcome to the show that answers your questions. This is Follow the Money Weekly with your host, economist and best-selling author. Here's Jerry Robinson.
Friends, welcome to you all around the world. Welcome to Follow the Money Radio. So grateful to have you here. We have a really good show lined up for you today. As you can see from today's title, we're going to begin by talking about Warren Buffett, as Warren Buffett bets against the U.S. dollar. That's quite a headline, and it is, quite frankly, the truth. What we've seen here over the last few months has been quite stunning. The world's top investor, at least when it comes to stock investing, is largely considered to be Mr. Warren Buffett, who heads up Berkshire Hathaway. And it's really quite something when you consider what has happened economically, and then you take into consideration what some of the top investors, guys like Warren Buffett, have been doing, right? When you don't pay attention necessarily to their words, but you look at their actions, it's very revealing. So here at Follow the Money, we have something we call the Elite Portfolio Tracker. And what it is it's basically a service that we provide to our Gold and Platinum members that gives access to Warren Buffett's full portfolio, also Bill Gates' full portfolio, and George Soros, also his full portfolio. But what's different about that, because you can actually get that information from the 13F filings that are produced each and every quarter. What makes it different, the reason why we provide it to our members in a special way, is that we rank these stocks according to our Smart Score ranking system. And that really provides a lot of value. So let me just give you a quick example. So right now, if you take a look at Warren Buffett's holdings, the number one holding that he has right now, according to our Smart Score system, is Amazon.com. The second holding, the ranked number 2 holding, is Apple, and then followed by several more stocks. And right now, by the way, Warren Buffett's portfolio is only composed of 44 stocks. It was about 51 prior to this latest filing. And so this makes Warren Buffett a net seller of stocks in Q2. Now, that is fairly interesting because Warren Buffett is the kind of guy, if you've read Warren Buffett's statements or you read any of his letters, his corporate letters or anything like that, you know that the man is a value investor. And when there's fear on Wall Street, there's blood in the streets, so to speak, he likes to buy. Well, in Q2, was there or was there not lots of blood in the street? I would say so. I mean, we saw a seismic sell-off in the overall stock market, which brought many asset prices down. And for guys like Warren Buffett, who claim to be value investors, they look for things to go on sale, they look for fear to be able to step into the market. You would expect guys like him to back up the truck whenever we saw the market, fall off of a cliff back in March. And what actually transpired from the data that we have is that he didn't back up the truck. Instead, what he did was he dumped stocks, right? He became a net seller. In fact, he is a massive net seller of U.S. equities in Q2. Now, that could change. That could change as we move forward. But it would kind of be strange for it to change because now valuations are even higher. So you would expect a man like Warren Buffett, who is a value investor, to be backing up the truck whenever you have a big seismic sell-off in the market based in fear, right? And that didn't happen. So what I want to do here is I want to briefly go over Warren Buffett's portfolio. By the way, later in the program, we're going to be joined by Rick Rule. Rick Rule is a friend of the show. He's been on the show a few times before. He is the president and CEO of Sprott U.S. Holdings, and he's going to be sharing some of the investing insights he's learned over the last 4 decades in the natural resource sector. We'll be talking about gold and silver. We'll be talking about some other commodities as well, so be sure to stick around for that interview. But so what I want to talk about here before we continue on with the rest of our podcast is Warren Buffett's portfolio. I just want to go over a few data points here as I'm looking at it. So first of all, Warren Buffett sold out of several stocks. He, in Q2, And I'm looking, by the way, at our Elite Portfolio Tracker service here. For our members, you can just go to your dashboard and you can see this in your dashboard. But Warren Buffett's portfolio, he sold Delta Airlines, 100% of shares. He sold Southwest Airlines, 100% of all of the shares. He sold American Airlines. He sold United Airlines. So all four of those big airline companies that he held, he sold completely, liquidated in Q2. Didn't buy any, right? Sold them, all of it. Liquidated the position. He also closed out his position in Occidental Petroleum, which is ticker symbol OXY. Completely sold out of that energy play. And then he also sold out of a Restaurant Brands International, ticker symbol QSR. That's not really surprising. Restaurants have been really hitting the chin here by the whole public health crisis. But another one that he sold that may or may not be interesting to some is Goldman Sachs. Ticker symbol GS. He sold out entirely of that particular position. So that was a bank stock that he had owned, and he just sold out. Now, he's still bullish on Bank of America, but this is quite a seismic shift that he has made. He also reduced shares in many stocks. I'm going to run through some of the stocks that he reduced. He reduced his holding in JP Morgan by about 62%. He reduced his holding in Sirius XM Radio by about 62%. Also, the PNC Financial Services Group, he reduced his shares by 42%. He cut a quarter of his shares in Wells Fargo, M&T Bank Corp, he cut 16%. Bank of New York Mellon Corporation, he got rid of that, or he got rid of 9% of his shares there, reduced those. He also reduced his holdings in Visa and MasterCard by about 5 and 7% respectively. And also Charter Communications and Liberty Sirius XM Group Series A, which is kind of an interesting ticker. But he cut some holdings there. He reduced shares. The only addition that Mr. Buffett made during Q2 was to pick up shares of Barrick Gold, ticker symbol GOLD. And that's a new holding for Mr. Buffett. And if you've listened to Warren Buffett talk in the past about gold, he's typically disparaged it, as most Wall Street types do, even as they, own it on their balance sheets. It's a tier 1 asset, so you can actually hold it, on your balance sheet. And it works out for the Fed, it works out for many of these banks. But for Warren Buffett, he's often disparaged gold, physical gold, owning it, calling it a pet rock and things like that. We've talked about that before on the podcast. And so whenever it was revealed that Warren Buffett had picked up shares of Barrick Gold, there was a lot of, hype on social media and whatnot about how, Warren Buffett was buying gold. He suddenly now likes the yellow metal. Well, I don't think you can build that case. The amount of shares that he purchased, it really literally only composes about 0.25% of his overall portfolio. So his overall portfolio, 0.27% is in GOLD, right? So it's, as Rick Rule will call it, it's a rounding error, right? It's a very small amount. However, it's also a big deal because Mr. Buffett, if Mr. Buffett had added Barrick Gold along with several other companies and wasn't slashing his holdings in some of these top name companies, like United Airlines and Delta Airlines and Goldman Sachs, right? And cutting his holdings in the banks, then you might be able to build the case that, well, he's just trying to take advantage of something here. Well, the fact that he cut all of these holdings and his only holding that he added was Barrick Gold, that tells us something about what Berkshire Hathaway perhaps perceives as coming. Now, it doesn't necessarily mean that Warren Buffett thinks gold is still not a pet rock. But at the same time, it also tells us that someone on his team, certainly Buffett may not have had a role in choosing this stock because he obviously has many underlings who do much of his grunt work for him. And it's possible that, that one of his underlings had just identified this as a good opportunity. And there's no doubt, whenever you look at many gold miners and you look at the future, if you can find one that's well priced, well positioned, has good fundamentals, it's going to be probably a good ride over the next several years. And that's what you think of when you think of Mr. Warren Buffett. You don't think of Mr. Buffett as a trader. He's not suddenly a trend trader now trying to take advantage of, a quick trend here or there. He's not trading. So he's buying this obviously with an intention of holding it, right, for a period of time. And what this really means is that while he may not be, extremely excited about the yellow metal itself, he does have to know that the amount of debt that the United States has taken on, and he's even talked about this before in the past, is creating a massive downward pressure on the United States dollar. And as the dollar goes down in value, it's going to benefit commodities. It's going to benefit things like gold. And so by holding Barrick Gold, by buying this, making it his only new holding, his only net buy in Q2, it tells us that he sees the writing on the wall, right? He certainly sees the writing on the wall. He knows that the dollar is going to be under pressure, and he's looking for a good, sound fundamentals gold mining play. And he's found it apparently in Barrick Gold. Now, we like several gold mining stocks out there. We, in fact, rank those as well by our Smart Score ranking system. In fact, let me go over on our website here, and I'll actually tell you some of those top Smart Score rankings that we have on gold mining right now. In fact, the very number one Smart Score ranked gold mining stock that we have according to our system that we use. And by the way, the Smart Score ranking is based upon several criteria. It's our proprietary system, and it ranks all U.S.-based stocks on 7 key criteria. New institutional buying, right? Existing institutional buying. You got to really watch the institutions here. High profitability. The higher the net income, the higher we rank the stock. High and stable earnings per share. Companies with high and stable earnings per share over the last 12 months achieve a higher rank within our Smart Score ranking. Low total liabilities will push it up in the ranks. Strong insider buying, like corporate executives buying. If they're actively buying the shares of the stock in that quarter, the last month, the last week, whatever, it'll push up that stock in the ranking system. And also high quarterly EPS estimates, earnings estimates. The higher those are, the more of a boost the company gets within our ranking system. So if we just look at the universe of gold mining stocks that are traded on the U.S. stock exchanges, what we find is that Newmont, NEM, that ticker symbol, ranks number 1. Now, that doesn't mean that it's my personal favorite. That just simply means that when we take a look at all of those proprietary criteria that we put in place for our Smart Score rankings, Newmont comes to the top of the list. And Newmont has actually done very well. Year to date, it's up 56%. Price target on it right now by analysts is about $73. The stock currently trades for about $67. So, that's where it's at. The number 2 Smart Score ranked stock right now is Kirkland Lake Gold. KL is the ticker. That one's actually underperformed many of the other stocks. Even though it seems to be very well positioned and has a good runway for growth, it's only returned about 23% year to date. We say only as if that's kind of paltry, but 23% in this universe right here is actually fairly low this year. Consider, number 4 ranking gold mining stock, Franco-Nevada, FNV. That's up 47%. And there's Barrick Gold down at about number 7 on our Smart Score rankings. That one's up 62% for the year. Wheat Precious Metals, WPM, that's ranked number 8 in our Smart Score system. That one's up about 77% for the year. Hecla Mining, HL, that's in our top 10 list as well. It's up 78% year to date. So gold mining stocks are certainly doing well this year, but we can see them doing well into the future. And that's certainly something we'll be talking about with Mr. Rick Rule later on in today's podcast. So it speaks something to us that Mr. Warren Buffett is actually reducing his overall exposure to U.S. stocks here. And the only stock that he found worth adding during the whole last quarter, whenever there was blood in the streets and fear running rampant, the only thing that he added was Barrick Gold. That tells us quite something, doesn't it? It really kind of tells us a story that the Oracle of Omaha did not see the sell-off as something that was worth backing up the truck for. And I think that speaks pretty loudly to us. Now, if you take a look at George Soros' portfolio, for example, in our elite portfolio tracker, you'll see that his top-ranked stock within our system is Google. And he has made a lot of changes. In fact, he did a lot of changes in his overall portfolio. He sold all of his shares of MasterCard, all of his shares of Booking.com, all of his shares of Dominion Energy. I mean, he sold a lot of shares. And that's not too uncommon with George Soros's portfolio, but we saw a really big shakeup this time. And he did add some new positions, which are pretty interesting and when you take a look at them. And then lastly, just looking at our elite portfolio tracker here, I'm just sitting here looking at it. I'm looking at Bill Gates' portfolio as well. He didn't add anything new as well. He has 23 stocks currently in his portfolio. The number one ranked stock that he owns is Amazon.com. It's ranked number one in our system. So that's the top holding according to our Smart Score ranking. And that composes just about 1% of his overall portfolio. But he did sell out of not entirely out of two stocks, but he did reduce his shares, his holdings in two stocks. So there were no new net adds, new buys for Bill Gates. There were a slew of changes in Mr. Soros's portfolio, and Buffett's, added one new stock, but saw his overall portfolio go down. He was a net seller of equities in Q2. So you may be asking yourself, why would Mr. Buffett be betting against the dollar? Well, if you've listened to this podcast at all, if you listen to our radio show for the last 10 years, it's hard to believe we've been doing these podcasts now for a full decade. We started back in 2010. It's incredible. And I want to say, thank you to all of our listeners all around the world who support this broadcast. And, for the last decade, it's incredible, how many podcasts we've done over the years. And, if you've listened to many of our podcasts, you know that we are, long-term bearish on the United States dollar. Now, that doesn't make us automatically bearish upon all stocks. It doesn't make us automatically bearish on, everything U.S. It just means that the U.S. has taken on so much debt that it's going to pressure its currency, right? It's going to pressure the U.S. dollar. And there's a headline out of the Wall Street Journal this week. It's entitled, "Coronavirus Lifts Government Debt to World War II Levels, and Cutting It Won't Be Easy." And just taking a look here at the first few lines of the article, it says, as countries worldwide boost spending to battle the new coronavirus, government debt has soared to levels not seen since World War II. Among advanced economies, debt rose to 128% of global GDP as of July, according to the IMF. In 1946, of course, in the post-World War II era, that number was at 124%. All right. So in July, the debt to GDP ratio among advanced economies is at 128%, and it peaked at an all-time high back in 1946 at 124%. So we've gone beyond the spending of World War II in the advanced economies, and this is really, really going to put a drag upon not just the U.S. dollar, but it's going to put a big crunch upon the debt markets because, you can only borrow so much, especially if interest rates are near zero. Now, there's another thing to keep in mind here. And this week, we're going to see something big from the Federal Reserve. The Federal Reserve, by the way, is meeting, and Fed Chairman Jerome Powell is going to be speaking on Thursday of this week during a virtual version of the Fed's annual Jackson Hole conference. And he's expected to outline what could be the central bank's most active efforts ever to spur inflation back to a healthy level. This according to a report from CNBC entitled, "Powell Set to Deliver Profoundly Consequential Speech, Changing How the Fed Views Inflation." Now, we talked about this a little bit on our last podcast when we were talking about the dollar again. And what we're saying here and what we're expecting here from the Federal Reserve is to see them change their overall target upon inflation. You see, back in 2012, I want to say it was around 2012, the Fed set a new target for inflation at 2%. And what that means is that the Fed, makes policy changes. They raise interest rates whenever they want to suck money back into the banking system. If there's too much money out there, they can raise interest rates. And of course, that leads you to put money in the bank or, to put money into, yielding securities. And then whenever they lower the rates, that of course pushes money out of the bank. So if they ever feel like there's not enough money in the system, which is, probably not something that's going to happen anytime soon, then what they do is they lower rates. And then if they sense that there is too much money, out there, then what they do is they raise rates. Well, what's the problem with having too much money in the system? Well, what happens is if you have too much money in the system, you have too many dollars chasing too few goods, it's going to lead to what? It's going to lead to higher prices, something that, economists refer to as inflation. Well, we believe that inflation is not just higher prices. Higher prices is the symptom of inflation. Inflation is actually an inflation of or an expansion of the overall monetary base. And that's what the Fed has been doing. So the Fed has been pumping a lot of money. It does this a lot by lowering interest rates. And now interest rates are practically at zero. Now, the Fed, as we all know, is going to adjust rates based upon what it perceives in the economy, right? And right now it has interest rates practically at zero. So the question that many economists are asking are, when is the Fed going to raise rates? And what's their standard for that? What are they looking at? What are they targeting to decide when they're going to raise rates? And so because in the past, the Fed had said we use a 2% inflation target, well, market participants would probably assume that once the official inflation rate reaches that area, it would be safe to assume that the Fed would begin raising interest rates. But what the Fed is going to do likely this week, and we haven't heard the speech yet, so we can't know, but what it seems to be, from everything that we've seen, from everything that we've heard, it seems that the Fed is going to play fast and loose with that number and is very likely going to raise that target from 2% up to probably a band, maybe of 2 to 4%, somewhere in there. They may not even give the actual number. It'd probably be wise if they don't. But what we're going to see likely is that the Fed is going to say that we're going to keep interest rates lower than we normally would. And the primary reason for that, from what we can understand, is that they are fearful that we here in the United States are facing a similar situation or a crisis that Japan has faced in the past and still faces, that Europe has faced, and that is stagnation. Stagnation and low inflation, overall low inflation. And because they don't want to get in the way of this rally, because they don't want to prematurely end the expansion that they're trying to create right now in the middle of this recovery, they're likely going to leave rates lower longer. That's probably what this speech is going to be all about. And that is enormously bearish for savers, right? If you have money sitting in the bank, you're not earning anything on it, are you? I mean, practically nothing, right? And with interest rates near zero, savers are being punished. You know, my good friend Barry James Dyke, who's a part of our Christian advisor referral here, whenever people contact us and say we were looking for a good financial advisor, Barry's one of the guys that we love to, send people to because he just knows his stuff. He's been doing this for decades. And he refers to this often as what it is. It's disintermediation. And that is that's kind of a big word to basically say that the Fed, by lowering interest rates, they force investors into high-risk assets just to get any yield. And that's exactly what the Fed, of course, has been doing. When they lower interest rates, they force savers into a situation where they have to decide, am I going to leave this in the bank and earn nothing? Or am I going to go out and take some risk even though I don't want to? Now I basically have to because I can't get any return from the bank. And so the Fed is very likely going to be kind of making a subtle but very large and profound shift in the way that it views inflation. We're going to learn more about that this week, and we'll be watching that. But I would encourage you, if you're watching this market, pay close attention to any kind of information that's given out about this speech afterwards, or even watch it if you're into it. But, pay attention to what's happening here, because this could mean that the dollar is going to have even further to fall. Now, with the level of debt that we are facing now, there's no doubt that the U.S. dollar is going to be under pressure for some time. But the Fed can actually complicate that and compound that if they take a laissez-faire kind of approach to inflation, right? That's really dastardly thing to do. I mean, to play fast and loose with the purchasing power of the United States dollar is, something they've been doing for a long time, but just to continue to do it, this is a devastating war on savers. And it's going to be, in my mind, very bullish for asset prices. I think you'll continue to see rising stock prices, obviously not straight up. Everything, goes up and down. I mean, I don't know where things will be 3 months from now. Who knows? But what I generally see is that the Fed is committed to seeing asset prices rise, right? That's their fear, is that asset prices go down. That's how you destroy Humpty Dumpty, right? That's how he falls off the wall, is if you have asset prices falling, right? They can't have that. So the Fed doesn't allow bear markets anymore, apparently. They're going to continue to drive asset prices up. I would expect real estate prices to go up. I would expect the cost of goods to continue rising. And so the Fed wants inflation. The Fed is obviously trying to stoke inflation. And as a saver, what are you going to do? What are you going to do? How are you going to protect yourself, right? Well, there's many ways to do it, but you've got to have a plan. You've got to have a strategy. And as I mentioned, we're going to have Rick Rule here on the podcast. In fact, he's coming up straight away. We're going to go and take a quick break. We'll come right back with our interview with Rick Rule to talk about the current state of the economy and how natural resource investing could be a solution for you. Hold tight. We'll see you on the other side of this break. Hey friends, this is Jerry Robinson here from Follow the Money Radio, and recently we have been receiving a lot of great feedback about our weekend ETF trend alert service. Perfect service if you are a swing trader or a position trader who likes to know when new uptrends are starting. We send out every weekend the latest ETF uptrend alerts by email for all of our members. Let me just give you some of the latest ones we have sent out that you, if not a member, you have missed. So back on May 8th of 2020, our members received an uptrend alert on solar energy, ticker symbol TAN. Since that alert was sent, TAN has risen by nearly 40%. We also called a new uptrend alert in silver. Many people know silver's on the run. We called that uptrend back on May 15th of 2020. We detected a new uptrend was forming, and since that time, silver has risen 45%. We called a new uptrend on silver miners, the ticker symbol SIL. For our members, we said the silver mining stocks look like they're forming a new uptrend. This was back on April 24th of 2020. Since that time, the silver miner ETF has risen 55%. We did the same thing with gold miners. GDX is the ticker symbol. We called that on April the 10th, a new uptrend alert. And since that time, gold miners have risen 47%. Every single weekend, our members are receiving these alerts. Now, of course, there has to be an uptrend for there to be an alert, but not every weekend we're going to have brand new alerts. But when we do, our members receive them. Wouldn't you like to receive those if you're not a member? Wouldn't that be something that would be beneficial to you if you're a swing trader or position trader? I would say it definitely is. And if you want to receive access to these uptrend alerts from us, all you have to do is go to followthemoney.com/join, choose your plan, and then begin receiving our weekend ETF trend alert service right there in your inbox each and every Sunday evening. If this sounds like something that would benefit you, just go to followthemoney.com/join, learn all about our services, and choose a plan, and begin receiving your ETF uptrend alerts each and every weekend from Follow the Money. Well, joining me on the line today is a friend of the show. He's been on the podcast before. His name is probably very familiar to you. His name is Rick Rule. He is the president and CEO of Sprott U.S. Holdings. And he's here today to share his investing insights that he's learned over many decades of success in the natural resource sector. Mr. Rule, it's great to have you back on the podcast. Thank you so much for joining us.
Thank you so much for having me back. I enjoy your audience.
Rick, we have seen some amazing things over the last several months. It's really hard to even put into words all of the different things that the average American has had to see, has had to face. It's been very difficult, very challenging, of course, for investors. But in all of that crisis, there's also opportunity that seems to be emerging. Before we get into some of the opportunities that you see, why don't we just kind of begin with just a general introduction to you for those who are not familiar with you and your work. As I mentioned, you are the CEO and president of Sprott U.S. Holdings. Many of our listeners are probably familiar with some of the ETFs that Sprott has put out, PHYS, for example, on physical gold, and PSLV, I think it's on silver. So you guys are behind, the Sprott brand is behind that. But tell us how you connected with Sprott. And kind of your background. How did you get into natural resources? How did you end up where you are?
Well, I'm a 67-year-old, made myself younger than I am, guy who has the good fortune to have spent really my entire adult life in the natural resources business. I identified natural resources as an area that I was interested in when I was in high school and emigrated from the United States to Canada to attend the University of British Columbia precisely because it had a degree program in natural resource finance. I have been involved in the sector. I've done some other things too, but I've been involved in the sector since that time, which is to say well in excess of 40 years in the natural resource sector. I built my own business beginning in 1990, and in 2011 sold my business to a longtime friend competitor, customer, and colleague, Eric Sprott. And I am now the largest shareholder of Sprott Inc. and part of the senior management team of Sprott Inc. Sprott Inc. in turn is a Canadian domiciled, U.S. listed, New York Stock Exchange listed natural resource manager. We manage or administer in excess of $15 billion, virtually all of which is in natural resources and precious metals. In particular, as you described, we have 4 physical commodities-focused trusts which trade on the New York Stock Exchange, a gold trust, a silver trust, a gold and silver trust, and a platinum and palladium trust. And in addition, we have 2 gold equities ETFs that also trade on the New York Stock Exchange, as well as a variety of other bespoke investment products servicing natural resource investors worldwide.
Okay, so you clearly have this affinity for natural resources, and we've talked to a lot of different natural resource investors over the years here on this podcast. And, you know, from what we can determine and from what we see from history, it's really a boom bust kind of market. I mean, you have times where there's a great demand and then you have low prices, and low prices are the cure for low prices, and then we see higher prices. But then we see the price come up and come down. So in some ways, this is kind of a trader's delight to trade, you know, natural resources. Now, I've certainly, the last time you were on the podcast, you had talked about how your early foray into natural resource investing was, you know, very lucrative. You were early, you said. You know, you kind of got into some of these natural resources early before a really big, large boom. So, but what was it that kind of drew you to natural resources? Why that? Why not technology? Why not, why not China? Why not some other area? Why specifically natural resources?
That's a good question. I suspect as a young man, it was because I like to spend a lot of time outdoors. The consequence of that is that I've been stuck in an office ever since. And I was brought up in San Jose, California, which is to say the heartland of Silicon Valley. One thing that has appealed to me about natural resource markets as I've aged, and you described this well, is that they're cyclical. The product cycles are fairly easy to understand and fairly broad. A good friend of mine has been one of the biggest technology underwriters in Silicon Valley for the last 45 years. And I remember him telling me that the average high-tech product cycle is 18 months before the product becomes obsolete. What that means is that by the time that I understood a technology, it would in fact be obsolete. So product cycles involving things like water or coal or gold or oil, where the product cycle might be 6 or 7 years, are certainly more suited to me. Simple, broad markets. I think it's probably impossible to be smart enough to be early in a technology market, but it's certainly not difficult to be early in natural resource or broad commodity markets because, as you say, the cure for low prices is low prices, and the cure for high prices is, in fact, high prices. That very simplicity is what has enabled me over time to take advantage of my own discipline and make money fairly consistently.
Rick, we've lived through some cycles here, certainly. You talk about these longer cycles, and we remember, of course, the bull market that began in metals back in 2000. It was a general uptrend that really took hold as the 2007, 2008 crash really began to permeate, and people began to look for solutions. And when they turned on television, they began to see gold commercials, and they began to hear about the national debt. We even think back to 2008 and the political situation that was going around that time. And the Tea Party was raging, and we were worried about the national debt. Remember those days, Rick? Remember when the national debt used to mean something? And people were actually worried about that. They were worried about the servitude, the debt slavery that they were, imposing upon their children and their grandchildren. That seems to have gone away today, Rick, but yet we have gold prices at, all-time highs. So So let's kind of back into gold here, because before I had you on, before we began this interview, we were talking on the podcast about Warren Buffett's recent move into Barrick, which I've heard you describe as a rounding error, and I think that's exactly right. If you look at his actual portfolio, Barrick Gold composes about 0.27% of the overall portfolio, so it's still very small, and it was the only purchase that he made in Q2. But that's really quite surprising, because we had this general cratering of the market, which is typically a time whenever guys like Buffett, who are value investors, they say, hey, when there's blood in the streets and people are fearing, that's when we back up the truck. And yet we had the market crash in Q2, and the only thing that he emerges out of this with is several sold stocks like banks and airlines, but then he picks up one stock, and it's Barrick Gold. So his move into gold stock, in that one gold stock, seems like perhaps a bet against the U.S. dollar. It doesn't necessarily have to mean that he is pro the yellow metal, and as I've heard you say, and I believe also, it's probably just an underling on the team that actually added the stock. But I guess what I'm asking you here is that we're really living in a seismic time where gold is at all-time highs, but we don't have all the gold commercials that we typically have seen in past cycles that haven't even really arrived yet. And guys like Buffett are dumping banks and adding gold miners to their portfolio. Help us make sense. How are you viewing this current environment, given what we've talked about here?
I'm viewing this environment precisely the way you ended your question, which is to say that the times that we're living in don't make sense. It isn't just that they don't make sense to me, they also don't make sense to Buffett. Buffett said he never anticipated a circumstance where the national debt wouldn't be paid off, but rather perpetually refinanced. And he doesn't think that negative real interest rates are a natural phenomenon. They're a function of confusion and confidence. And the consequence of that is that he is nervous about a circumstance where the Fed runs out of a store of goodwill. In other words, loses the confidence of the markets, and where the markets themselves take control of interest rates, which would, of course, be very, very difficult for all of society, but in particular for the large financial services institutions. I myself believe that it is likely, I'm not an economist, by the way, I'm a credit analyst, so take this next part with a grain of salt. But I believe that irrespective of Buffett's feeling, because I think Buffett still does feel that gold is a pet rock rather than anything else. But really, the consequence of his statement is that it is becoming obvious to many people that there are circumstances which cause the wind to be in precious metal sales. And let's review those for your audience. The first is quantitative easing. I know that your audience is fairly young, and so what they need to understand is that quantitative easing is government speak for counterfeiting. If you did it, you would be in prison. When the Fed and Congress do it, it's policy, and it's popular policy, and they get reelected. But it does, in fact, debase the currency. And gold does well when people are concerned about their ongoing purchasing power in other savings instruments. So the debasement of the dollar is good for gold. Then, of course, there are the debt and deficits, related, of course, to quantitative easing, but a separate factor. The aggregate debt at the federal level on balance sheet exceeds $24 trillion. And the off-balance sheet liabilities, which are promises that we have made, things like Medicare, Medicaid, Social Security, the Environmental Trust Fund, things like that, exceed $100 trillion. So the total on-balance sheet and off-balance sheet liabilities of the U.S. government exceed $120 trillion. Now, you would service that debt with the national income, which is taxes and fees minus expenses. The problem, however, is that the national income is in deficit. The deficit for the month of July alone, 1 month, was almost $1 trillion. It's very difficult, and I'm being facetious, to add a column of negative numbers and come up with a positive sum, particularly a positive sum large enough to amortize $120 trillion in on-balance sheet and off-balance sheet liabilities. That number, by the way, is before state and local debts. So we have quantitative easing, which is to say counterfeiting. We have debt and deficits, and then we have negative real interest rates. The interest rate is the compensation that savers are paid to forestall consumption, and also the risk premium associated with lending money to a borrower. The idea that the interest rate on the U.S. 10-year Treasury is 50 basis points in a currency where the Congressional Budget Office says that the purchasing power of the currency is being destroyed at 160 basis points a year means that if you lend money to the U.S. government, your savings will be depleted, guaranteed, by about 1% a year. Jim Grant calls that return-free risk.
Yeah.
The fourth factor I think that's useful to understand with regards to precious metals and precious metals-related investments is they're still highly unpopular despite the price moves that we've seen in the last year and a half. It was calculated that the market share of precious metals and precious metals-related assets in the United States relative to all classes of savings and investment products was less than 0.5%. Now, in 1981, at the height of gold's prior popularity, it is estimated that the market share of those asset classes relative to all asset classes was at 7%. But more importantly, the 3-decade mean market share for precious metals and precious metals-related assets was about 1.5% to 2%. So if, as a consequence of the debasement of the currency, negative interest rates, and debt and deficits, if the consequence of that is that interest in gold just rises to the level of market share that it's enjoyed over the last 3 decades, you would see a tripling or quadrupling of demand for gold and precious metals related assets. And I think that's what's going to happen.
So that's very interesting. So now, without getting too political here, I want to throw something out to you and just kind of see if we generally agree on this. We don't know who's going to win the presidency. If you look at the polls, it seems to be very clearly in the favor of Biden, but we know what that meant back in 2016. So we're not really looking at the polls too much here. And probably from a perspective of an investor, just like Warren Buffett has said, and I agree with this, is that we really shouldn't take politics into account when it comes to investing. Our investing really shouldn't be driven by politics, but we can't help but see that the narratives can often change based upon who is in office. And so the way I see it, Rick, and maybe you can comment on this, is that if we have a Biden presidency, if Biden wins in November, I would expect that we would see a sudden and almost immediate revival of the Tea Party talking points. We would automatically see a sudden urgency to pay off the national debt, a sudden urgency about how the dollar is going to collapse and how gold is the solution, which would be very good for Sprott Holdings. It would be very good for, gold bugs in general. So a Biden presidency almost seems very good for that narrative to kind of continue again, where it's been muted for a long time. Perhaps Trump, if Mr. Trump is reelected, we might see kind of a hampering of that narrative, that Tea Party narrative, because we haven't really seen it during his full 4-year tenure. We've kind of seen that narrative go away. At some point, I guess, it's going to have to explode. People are going to have to realize that they're going to have to talk about the national debt, but it would seem like it would be easier under Biden. Does that all make sense to you? Do you agree with those comments, or do you see something I'm not seeing?
I don't, in my own limited experience with the Tea Party, believe that most of the Tea Party people are or were in favor of sharply limited government. So I think irrespective of which party is in power, that the circumstance that confronts us will continue to confront us. I do believe that a Biden victory would make the group that I call the country club Republicans old, fat, rich white guys like me nervous. And I think it could be very, very damaging in the near term to the S&P 500. It could be, I'm not saying it would be, it could be a circumstance where declining equities prices brought us into a new liquidity squeeze, similar to 2008 and similar to March of this year. And if that happens, I have no doubt that the policy response would be even greater artificial liquidity, greater deficit spending, greater debt and deficits, which would, if it occurred, be very good for gold. My experience has been that the gold market reacts to the policy response to crises, which is to say that the gold market really reacts to negative real interest rates in savings products like the U.S. 10-year Treasury. Mm-hmm. And I think really irrespective of which party gets elected, that the current yield to politician, which is to say the policy that both parties favor, is artificial liquidity and artificially low interest rates. So I think, unfortunately, both parties will be good for gold and bad for the country.
Mm-hmm. Can't agree more. Okay. So you have talked often about the Barron's Gold Mining Index. I think that's a wonderful chart for people to look at. We have a chart of that index on our website as well for people who want to see it. This index goes back to about 1939, so it gives you a really good idea of how gold mining stocks, in the aggregate, have reacted to various phenomena in the country over the last many, many decades. And when you look at it today, you just can't help but see, a brand new uptrend, on the way. And when you think back about some of the different uptrends that we have seen in the gold mining space, it just doesn't seem quite like we have ever seen the forces aligned like they are today in favor of this uptrend continuing. And almost, as you've pointed out, not either political party can really do anything to stem it. So can you talk a little bit about the Barron's Gold Mining Index and just gold mining in general, just for a minute? For those who are out there saying they're bullish on gold mining, they want to maybe buy, a gold mining ETF, or they want to pick out certain gold mining stocks for their portfolio. How are you viewing gold mining as we go forward here? Do you think that this uptrend perhaps has more steam than we've ever seen before?
Well, I'm delighted that you refer to the chart because it's a wonderful visual aid. The chart shows your listeners several things that they have to pay attention to. First, it shows two full-cycle bull markets, one beginning in 1970 and ending in 1981. You'll see that in the chart, and it's really, truly a dramatic chart. If you look at the rise from the lower left to the upper right, you'll see an amazing chart. You'll see another one that's fairly similar to it, beginning in 2000 and ending, depending on your point of view, in 2008 or in 2011. But it shows something else, too, within those bull markets and also within the bear markets that followed them. It shows 8 recoveries, sharp recoveries from oversold bottoms. So even without a bull market, there have been 8 circumstances where the market recovered from being oversold. And those recoveries on an index, not the best individual stock, but rather on the index, featured the weakest gain, which was 150%, and the strongest gain, which was 1,100%. Mm-hmm. Referring again to the chart, there's 2 important lessons. If you look at the far right side of the chart, which is where we are now, you will see that we are likely either in the sort of middle stages of a recovery from an oversold bottom, or in my case, much more likely, in the early stages of a new gold bull market. If you look at where the equity indexes are, both relative to gold, but also in an absolute sense, these indexes are cheap. And if you combine where we are in the market now with the tailwinds that we've already described in this interview, the tailwinds affecting gold, silver, and precious metals investments, I think the chart is illustrative. The other thing that I want your listeners and viewers to pay attention to in this chart, if they have the ability with their computers to blow the chart up and look at some of the individual recoveries from oversold bottoms and also look at the anatomy of the bull markets, what you'll see is that gold is also, or gold mining stocks, pardon me, not merely cyclical, they are also volatile. So even in a secular gold bull market, which is what I think we're in, you can have some astonishing cyclical declines. The gold equity index can sell off by 15 or 20%, Jerry, the same way that you and I inhale and exhale. I remember myself in my first gold bull market, the 1970 to 1981 bull market. I remember very well gold staging a really handsome run from $35 an ounce to about $200 an ounce in early 1975. And then there was some Fed tightening, which strengthened the dollar, raised real interest rates, and the gold price fell from $200 to $100 an ounce. It had a 50% decline in 7 or 8 months. The Fed lost their nerve, and people who got shaken out of gold as a consequence of that cyclical decline missed a move in 6 years from $100 an ounce to $850 an ounce. The point there is that gold is cyclical, but gold is also volatile. Expect volatility.
Let's move to silver for a minute, because silver has certainly taken center stage over the last several weeks and even the last couple of months. So here at Follow the Money, Rick, you know we have a trend trading system is what we basically do, and we look for new uptrends. We identified a brand new uptrend in silver on May 15th. Silver had languished for years underneath the kind of the 1850 to 2150 range from a technical standpoint. We had been thinking that if we would ever see a nice breakout above 2150, that we could really see some legs to the rally. And sure enough, our system identified May 15th was about the day that we said, okay, this looks like it's firmly turned into an uptrend. When it hit that 2150, Rick, it just kept going. And it's not, and we know that's kind of how silver is. It tends to just outpace gold once it really, really heats up. So many people are starting to pile all in on silver. They say, well, this is kind of a can't lose kind of investment. I like your experience in this space, because as you've pointed out, many people who get into these markets like silver, or even gold for that matter, thinking that it's going to go to the moon, they can often be heartbroken if they're not prepared for the volatility that you've explained. So certainly gold can be volatile, and gold mining certainly, but silver maybe perhaps even more so.
Silver will give you volatility on steroids. There's no doubt about that. And the circumstance that you discuss is one that's borne out in history. Precious metals bull markets begin with gold because the gold buyer is a fear buyer. The silver buyer, at least North American silver buyers, are greed buyers. The momentum has to be established by gold before silver follows. Silver in other societies, South Asian societies as an example, Bangladesh, Pakistan, India, Sri Lanka, in those economies, silver also sees a fear buyer that can't afford the unit price of gold and is forced to use his or her silver to buy, his or her savings to buy silver. But it has always been true, at least in the 40, 45 years that I've been in the market, that gold leads and then silver follows. But as you point out, when silver begins to move, it moves further and it moves faster than gold does. The silver stocks, at least the high-quality silver stocks, seem to be, in most bull markets, the most amazing outperformers of all. When people crowd into the silver and they want leverage, then they crowd into the silver stocks. But there isn't enough market cap in the silver stocks, at least the good ones, to hold the money. My friend Doug Casey used to describe the flow of generalist funds into silver stocks as being analogous to attempting to siphon Hoover Dam through a garden hose. There just wasn't enough capacity to hold it.
Let's turn to natural gas for a minute, because I do want to get your take on a few other natural resources before we bring this to a close. Natural gas is a real interesting market. Many years ago, I even worked on a energy trading floor back in the early 2000s, where, of course, it was wild times. Energy traders and natural gas traders were, it was just a wild time. I remember crazy things, but we've really seen that kind of calm down since the peak in 2008 in natural gas prices, and they've come down, and we've seen just kind of this real depressed kind of market now because, of course, so much supply that we have here in the United States. Now, we've been watching that market now for some time, and we saw it early in 2020 bottom out near its 2016 and 2012 lows that it had reached, and it started to come back up with a little bit of a vengeance over the last few weeks. It's been coming on our radar, and we detected what we call, again, a new uptrend on the weekly chart. It's hard to get excited about natural gas, Rick, from my perspective, because there seems to be, record inventories and so much, kind of gloomy news going forward. But there's also, a bull case on natural gas. Can you talk to us about your view of natural gas, and what do you see longer term?
Yeah, I do. I think it's fascinating, and I'm fascinated by your trend following service. My good friend Steve Sugarroot says that the ideal investment is absolutely cheap, unloved, but in an uptrend. Mm-hmm. And I think what you've done is you have captured his thesis in a topic. It's important that anybody who follows your advice with regards to natural gas either be a very adept trader, because it will be volatile, or have a very long perspective. Natural gas is a great subject to discuss around the concept that markets work, and the cure for low prices is low prices. Because of the technological revolution in the U.S. oil and gas industry, which is to say three-dimensional seismic, horizontal drilling, and fracture stimulation. We've had a tremendous boom in oil production in the United States and a tremendous boom in associated natural gas, which is to say natural gas that's produced in conjunction with producing oil. That boom was exacerbated by artificially low cost of capital. It's a capital-intensive business, and the most important input, frankly, in oil and gas production is money. And the fact that money was artificially cheap meant that we had a tremendous boom. And that boom meant that the production cost for many producers for natural gas was zero, because it occurred as a necessary consequence of producing oil. So we had an enormous oversupply of natural gas. And people thought that natural gas would never come back. What they had a hard time recognizing was that markets always work. This period of very low prices has stimulated demand. The United States was a natural gas importer. Now we're a natural gas exporter. The increasing reliance on alternative energy in the United States, which is to say interruptible energy, wind and solar, means that during periods of time like night when the sun doesn't shine, or during periods of time when the wind doesn't blow, we experience power outages like California is experiencing now. And the very low price of natural gas has meant that it's a wonderful, wonderful commodity to use to provide peaking energy when energy is needed. And it's also useful as a feedstock for chemicals and stuff like that. So the consequence is that this period of very, very, very low prices has stimulated lots of utility in the market for natural gas, while the recent decline in oil prices and the recent lack of favor that the oil industry enjoys has increased their cost of capital. So byproduct gas supply is falling at the same time that demand continues to increase. Now, it's my personal belief, and I'm not an economist, it's my personal belief that we are going to continue to experience trying economic times around the world. I think we have to work off the excesses of the 2009 to 2019 economic recovery. And I also don't think that we have properly amortized, at least in financial markets, the economic damage done by the COVID-19 virus. So I'm not expecting aggregate economic output to increase much in the 2, 3, or 4 year time frame, which means that I don't think that we'll see explosive increases in demand for natural gas. But what you will see in natural gas is supply constraints that come about as a consequence of much less oil and gas drilling in the United States and almost no focused natural gas drilling. And what happens is that when you balance supply and demand by reducing supply, when you constrain sustaining capital investments and constrain new project investments, when the market begins to firm, which is to say when supply and demand meet and the market prices begin to go up, the industry can't respond to those positive pricing signals by increasing supply, because supply takes years and lots and lots and lots of capital. So at some point in time, you are going to see a circumstance where the natural gas price increases at least enough that natural gas producers can earn their cost of capital. Or you're going to see a circumstance where the oil price increases enough that you see a resumption of horizontal drilling and fracking activity in the United States and an increase in byproduct supply. I am, as we speak, looking at pretty dramatically increasing the oil and gas equity exposure in my own portfolio, with the view to the fact that it might take 2 years or even 3 years to be right. But when I'm right, I suspect I'm going to be really, really right. I'm going to be right like I was in 2001 and 2002, which is pretty dramatic.
Mm-hmm. You're listening to the voice of Rick Rule. He's the president and CEO of Sprott U.S. Holdings, and he's sharing his investing insights learned over 4 decades of success in the natural resource sector. Rick, I really appreciate your time. We're kind of in the final innings here, but I do have some questions from our audience that I did want to address. I don't want to leave them out. I want to have them ask a couple of questions. We have one here from Giannis, and it kind of brings us back to our topic of gold. And his question is simply this: do you think that the value of precious metals will crash as we become a more interstellar species in the relatively near future and begin to mine metals from asteroids, moons, and other planets, and even as supply skyrockets? Of course, Giannis is referring to the big project by Elon Musk, who is talking about shooting asteroids out of the sky or mining them, of course, for the precious metals. And it is true. I mean, I guess in these asteroids, there's a tremendous amount of supply of precious metals. How realistic do you view that? I mean, you're certainly in a position to speak on this topic. How threatened do you feel by that?
Absolutely not threatened. Gold is extremely heavy, and the process by which you extract it from its host rock is extremely heavy and extremely energy intensive. And the ability to either move material from where it is to where it's needed, which is to say on Earth, or alternatively to export enough material and enough energy to extract it in space, is not something that I think will be a factor in the gold market. Never mind in my lifetime, I'm 67, but in the questioner's lifetime, I think you will see technology that makes it more efficient to both find and produce gold. And my suspicion is that the gold price will rise and fall over time as a consequence more of government action, frankly, than the industry. But if I was going to be concerned about supply, I would be concerned about supply coming from more conventional places like the Tethyan metallogenic belt, which runs effectively from Turkey to Mongolia. Very, very, very unexplored terrain. But even that, I don't think, will be able to impact gold supplies for 15 or 20 years.
Another question we have here, Rick, is in regards to uranium, which is good because we wanted to talk about uranium today on this interview. And this question comes from Steve. He said he would love to get your current thoughts on the uranium sector. He heard you once say, a quote, "The uranium price must rise or the lights go out." Perhaps you can expand on that statement.
Well, I think that's true, and I'm delighted to have the opportunity to answer that question. I love the uranium market. A contrarian looks for opportunities that other people for various reasons don't look at. And uranium qualifies as the ultimate contrarian investment in the sense that nobody's made any money on it for 7 or 8 years. In fact, they've lost a lot of money. But more importantly, people react viscerally to it. They aren't merely bored by it, they hate it. There will be people who respond to this discussion by describing me as a despicable human being looking to profit off Fukushima, Chernobyl, Three Mile Island, Hiroshima, and Nagasaki. Now, a contrarian lives for that. What people tend to miss in their uranium narrative is that even in societies that perceive themselves to be rich, like the United States, uranium contributes about 15% of the electricity consumed in the United States and about 20% of the baseload, high-quality 24/7 power available in the United States. Will the market share of wind and solar increase? Yes, almost certainly, but it doesn't matter. We're experiencing rolling blackouts in California as a consequence of about a 4% shortfall in supply. If you have a shortfall of supply in the United States of between 15 and 20%, you won't have rolling brownouts. The lights will go out. Now, the International Energy Agency estimates that the total cost to produce a pound of uranium, by total cost, I don't just mean mining cost, I mean cost of capital, general and administrative costs, and importantly, prior write-downs of failed projects, is between $50 and $60 a pound. So right now, the industry is making this stuff, let's call it for $50 a pound, and they're selling it for $30 a pound, losing $20 a pound, and doing it about 90 million times a year, which is fairly boring. The consequence of that is that we're beginning to see precipitous declines in supply, in the ability to produce uranium. And when we have exhausted the surplus above ground inventories that exist as a consequence of the shutting down of the Japanese nuclear fleet, which was itself a consequence of the Fukushima disaster, I think you see sharply higher uranium prices. When your viewers want to test my thesis, they need to ask themselves the question that I've asked before. Do you believe in 6 years or 7 years from now, it is more likely that you see higher uranium prices, or you believe that the lights are going to go out? Because one or the other is going to happen. I believe you're going to see higher uranium prices. You cannot shut in 15% of U.S. electrical supply or 20% of U.S. baseload supply, and you can't replace it in the 5 to 7 year time frame. You can't do it. So one circumstance or the other is going to occur.
We've talked about a lot of natural resources today, Rick, a lot of different ideas, a lot of different opportunities. Many people might be listening to this and saying, this sounds great. I want to maybe go put some money into some different natural resources. Let's temper that. And you've been doing this for 40 plus years. Why don't we conclude this interview with maybe some words of wisdom from someone who has ridden the roller coaster, so to speak, several times. What does the temperament, what is the risk profile, what is the right person to be delving into this? What's the wrong kind of person to be delving into this? What should the person know as he as the prospective investor? Give him some tips as he begins this journey if he wants to.
Well, I actually believe that every portfolio needs a little bit of precious metals, needs a little bit of savings that is in a financial asset that isn't simultaneously somebody else's liability. which is to say metals as opposed to fiat currencies. I don't think that there's any investor who ought to be without that. Natural resources you need to own when they are cheap. And I can send your listeners 2 charts, long-term charts, that suggest that natural resources are cheap. But as you suggest, there are some cautions. The first is that natural resource stocks are stocks. And if you have a general market decline, a panic, a liquidity-driven panic of the type that you saw in 2008 or in March of this year, natural resource stocks will go down, just like other stocks. What's interesting is that cheap stocks of all stripes recover more quickly than the broader market. It is also true that natural resources are cyclical, and you must be a contrarian in natural resources or you are going to be a victim. If you focus your efforts on natural resources in stocks related to commodities that have already risen dramatically in price, what happens is that you will learn a rueful lesson about how well markets work. Nobody wants to buy oil when it's at $25, and everybody wants to buy oil at $100. But the truth is the cure for high prices is in fact high prices. And when oil is at $100, it is heading over 5 or 6 years for 20. That's the way it works. When oil is at 20 or 30, it is headed to 80 or 100. That's also the way markets work. So you need to cement in your mind that you must be a contrarian or you are going to be a victim. And then the final thing that you have to do is you have to adjust yourself to volatility. If you learn that what volatility is a fairly frequent set of sales, then you understand how these markets work. Whether or not you take advantage of the sales is a different circumstance. But one thing that might work extremely well for listeners of your show would be to buy high-quality positions, that is very, very high-quality natural resource companies, large liquid companies, and then sell puts and calls against that core position during periods where the VIX, the volatility exchange, is over 20. This is a circumstance that is probably really well geared to a service like yours. Being paid to buy low and sell high, something that you ought to be willing to do for free, isn't a bad bargain during periods where you can monetize volatility, which is to say you can sell 90 or 120-day puts and calls around core positions. The truth is that you don't need to do that. What you need to do is position yourself in out-of-favor commodities and then let nature take its course. When nature has taken its course and the profits are on the table, which is to say when commodity prices are high, the normal human tendency is to look at those pricing signals and have those pricing signals justify the narrative that gave you the courage to buy the position in the first place. And you need to resist that temptation because the cure for high prices, irrespective of narrative, is high prices. So you need to develop the psychological discipline both to buy low, but then also to sell high.
Very, very difficult. So much easier said than done, isn't it? Whenever you're seeing the price go up and up and up, at some point you just have to cut, and it becomes very challenging. That's probably the toughest part, isn't it? It really is.
I was merely going to say, perhaps as a consequence of my age and experience, I always buy early, and I always sell early. And while that is in fact a failing, it's better than the other failing. It is better than the other failing.
And Rick, I know that you had a special offer for our listeners. I want to give you just in the last final moments here of our interview, you had made a generous offer. Feel free to share that.
Yeah, I really enjoy interacting with your audience, and I've done a lot of it since the Prospectors and Developers Association, the first interview that you guys did with me in March. And the offer goes like this. Any of your listeners or viewers who would like to may have me personally review their natural resource portfolios. Go to a web link, sprottusa.com/rankings. you'll find a web form where you can enter the names and symbols of the natural resource stocks that you own or are considering purchasing. And I personally will rank them 1 to 10, 1 being best, 10 being worst. I will also comment on individual issues where I think that my comments have value. And further, I will include in the return email a copy of the Barron's Gold Mining Index chart, which I think is the best visual aid available to understand the dynamics of the precious metals equities markets. And further, I'll include a 100-year commodity chart, which will let you know just how cheap industrial commodities are relative to their price levels over the last 100 years. By the way, I'm not saying that we are in a commodities bull market yet. I think we'll be in one 3 years from now or 4 years from now. But I think it's also instructive to know just how cheap the stuff of life is relative to the price levels over the last 100 years. So I'll do rankings and I'll send those 2 charts. And to the extent I can, I'll answer follow-on questions. I would also say to your listeners, please be patient. This offer has attracted an awful lot of respondees, and so I'm fairly seriously behind.
Fantastic. Thank you so much for your time, Rick. Really enjoyed it.
Thank you very much for the opportunity. I enjoyed it myself.
Hey friends, this is Jerry Robinson from Follow the Money Weekly. Recently, we have been receiving many emails from our listeners commenting on the great help they're getting from our precious metals expert, Tom Cloud. Gold and silver are excellent hedges against the growing threat of coming U.S. inflation. Who's your gold guy? Make it Tom Cloud. With over 30 years experience with precious metals, Tom will answer all of your questions. Don't buy your gold and silver through some call center and pay inflated prices. Call my good friend Tom Cloud and speak directly with him and get all of your questions answered. For a limited time, Tom is offering free shipping and insurance on every gold and silver purchase made by our listeners. Call 800-247-2812. And when you do, tell him that Jerry Robinson from Follow the Money Weekly sent you, and he'll throw in that free shipping and insurance on your entire order. Call your gold guy, Tom Cloud, right now for the very best deals on gold and silver coins. 800-247-2812. That is 800-247-2812. All right, friends, and that brings us to the end of our program. Thank you so much for tuning in. I sure hope you enjoyed that interview with Rick Rule and our discussion on the topic of natural resources. And as always, I'd like to leave you with a final word, this time by the great Roman poet Horace, who was the leading poet during the time of Caesar Augustus in the Roman Empire. Horace said, "He who is greedy is always in want." Very succinct, and how apt. It's perhaps the irony of all ironies that in all of the pursuit for money and material goods, greed and the lust for more never satisfy. Greed is simply a bottomless pit. And Jesus Christ himself warns us in the Gospel of Luke to be on guard against every kind of greed, because our lives are not measured by how much we own. One of the simplest ways to combat greed in our own lives is to make charitable giving a priority. The very first step of our 5 levels of financial freedom is to create a charitable giving plan. And you can learn all about this with our free video and charitable giving PDF download on our website at followthemoney.com/giving. Friend, don't let greed shipwreck you or your faith. Money is a means to an end, and we are called to be good stewards. But money should never be the end in and of itself, because it can never satisfy. And that's just something to think about. Remember, friends, when you want the truth about the global economy, just follow the money. Have a safe and prosperous week, and we'll see you right back here next time. Until then, God bless.
All of the information contained on the Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of ftmdaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any financial decisions.